It's panic in the White House as recent policy makes the U.S. highly vulnerable. I'm your host, Steven Van Metre, and thanks for joining me today. And what may appear as a reversal in policy and perhaps an admittance of wrongdoing is really the government speculating in the markets. Let's head over. We picked this story up first on CNN as Biden administration launches plan to refill emergency oil reserve. The Biden administration plans to seek bids this fall to buy 60 million barrels of crude oil as a first step in a years-long process aimed at replenishing America's emergency oil reserve. This would mark the first time since the early 2000s that the Energy Department has acquired large quantities of oil for the U.S. Strategic Petroleum Reserve, the largest emergency supply of oil on the planet. And the Energy Department plans to announce the launch of the long-term buyback plan on Thursday to show officials are serious about eventually refilling the SPR, which has been drained by the war in Ukraine and sales mandated by Congress to raise revenue. But that will take time. Delivery of the first tranche of 60 million barrels will take place in unspecified future years, the Department of Energy said, adding it will be paid for with revenue received from ongoing emergency sales. And so you've already got a hint that they're hoping to sell high and buy low. The SPR serves as a vital national security and economic tool to buffer the United States from energy price spikes. Presidents have released oil from the SPR during times of war and after natural disasters. Reserves were already sitting at 20-year lows. I want you to understand, 20-year lows, largely because of congressionally mandated sales before President Joe Biden promised in late March to release a record-setting 100 million barrels of oil over the next 6 months, or 30 million barrels a month, to ease pressure on energy markets. The latest release amounts to a loss of 1/3 of the oil still left in the SPR. The first tranche of purchases will cover only 1/3 of that 180 million barrel release. And so, as you can see, we're already at dangerously low levels. We're going to take those levels down even further, leaving us with very little margin for error if there is further shocks to the energy market. The specific timing will be determined by expected market conditions, focusing on when oil prices and demand are forecasted to be significantly lower. Again, the government attempting to speculate on the oil market. Of course, there's uncertainty over where prices and demand go. The war in Ukraine highlights how unexpected events can have great impact on the energy markets. And beyond trying to refill a vital rainy day fund, the Biden administration hopes a buyback plan will encourage domestic oil production by guaranteeing a source of future demand. And so here you see another attempt, again, by policymakers to spur employment, get people back to work, tell the oil companies, we'll guarantee these purchases at a future date. You go out and hire and get us that oil. So you can see there's two objectives here, not only to sell high and buy low, but to put people back to work. McNally, now president of consulting firm Rapid and Energy Group, cautioned that the Biden administration's efforts to buy back oil will only partially reverse the drawdown in the SPR size in recent years. The buyback plan won't impact congressionally mandated sales of oil from the SPR aimed at raising revenue to ease the federal deficit. Congress has been irresponsibly selling the SPR down, according to McNally. Draining the reserve leaves the country and the world more vulnerable to geopolitical shocks. And I want you to be thinking, what we're doing here as a country and what we have done. If there is another, financial crisis or another energy shock or some event that puts pressure on the global economy and on the financial system, what ability do we have to respond? And the answer is very minimal. We did a ton of fiscal stimulus and drove the deficit up. The Fed did an unprecedented amount of monetary policy, and now we're draining our strategic petroleum reserves to combat inflation, leaving us with almost no margin for error should there be another crisis. But if there's one thing that should have a margin of error if there's a crisis, and that's your portfolio, be sure to check out Portfolio Shield. I'll put a link up here in the corner and in the description below. All right, let's continue on because, the story here gets a little more interesting. As U.S. job openings and quits reach record levels in March, perhaps some people will go back now that they see all these coming demand for oil jobs, as employers posted 11.5 million job openings, according to government estimates, as people quit jobs 4.5 million times. The Labor Department said 11.5 million job openings in March increased from 11.3 million the prior month, suggesting that there should be a ton of people getting hired. But hang tight. We're not seeing that at all, and perhaps there's a reason why. The number of times workers quit their jobs rose 4.5 million the same month, slightly higher than the previous record in November of the last year. Meanwhile, hiring cooled slightly from the month before to 6.7 million hires in March. And so why do you see people quitting? Is it because they're retiring? Is it because, their portfolios are up? Not necessarily. In times of high inflation, when employees go to their employer and ask for a raise, they're generally turned down or get a much smaller raise than they want. And if they go out into the job market, they'll find that some other employer will give them a much larger raise, so they quit and job hop to get more money. And that's why you see quits tend to rise when there's high inflation. There's a little sign of cooling in the greatest job seekers market of all time as businesses continue to face high turnover and the gap between demand for labor and supply widens. And yet there is a way that can be fixed, as we'll talk about in a little bit. Businesses will continue to experience upward pressure on wages. The number of job openings continues to exceed the number of unemployed people seeking work. In March, there was nearly 2 job openings for every unemployed person, according to the Labor Department. And as we heard from Fed Chair Powell in his recent press conference, he cited that data suggesting that there is a tight labor market that will lead to higher prices or higher wages. And while there's some ways to bring that down, bring that demand down, which is what he's trying to do, of course, the stock market may actually help him out quite a bit, as we'll look at here soon. And the U.S. economy added 428,000 jobs in April. The question is, with 11.5 million jobs available, why isn't there one in front of this number? And the unemployment rate remained low at 3.6%. Demand in the U.S. has continued to be strong as Americans are still spending at a solid clip, particularly on services such as concerts and travel. Employers are trying to hire workers to accommodate these customers. And with 11.5 billion job openings, the question is, why aren't they getting people back to work? Perhaps its wages aren't high enough, or at least the offer isn't high enough to bring people back. The labor market's latest issue has been the supply side, with an unusually tight pool of labor available to fill jobs, a dynamic that has fueled a record wage growth and put rising pressure on inflation. In March, there were just under 6 million unemployed people seeking work. And what doesn't make sense is average hourly earnings in April on a month-over-month rate slowed from 0.5% to 0.3%. Even the average hourly earnings on a year-over-year rate of change slowed from 5.6 to 5.5%. And with all this need for workers, you might think that hours worked would go up, and they too were unchanged. Notice here in the middle, these were the estimates, everyone thinking the number is going to go higher, perhaps suggesting that all this demand for labor, well, there actually may be something wrong with the underlying economy. But will there be a big surge in people looking for work? Well, if the stock market has anything to do with it, there will be. Let's look at this chart here, which is a 4-week moving average of initial claims. So this is when people make an initial unemployment claim against the Wilshire 5000 price index, which is the entire U.S. market. And notice that as claims rise, the stock market goes down. As demand goes down, people file claims. And you can see stock market going down, initial claims rising. How about with non-farm payrolls? Well, when the stock market goes down, notice the demand for workers goes down as well. And what actually happens at the same time is those who are on the sidelines, who perhaps got wiped out in the stock market decline, well, they head back to work as well. But what about the structural problems lying underneath? Well, the participation rate actually declined, which is interesting because the number of people with all this demand for labor participating in the labor force declined, suggesting that perhaps there is something deeply wrong with our economy. Let's take a look at this. As the velocity of money, or the number of times money is exchanging hands or used in a transaction over a period of time, against the labor force participation rate in red. And I want you to notice that when you see the velocity of money, so it means money is not moving very quickly through the financial system. It's not exchanging hands very quickly, and it has a very nice relationship with the labor force participation rate, which is the number of people participating in the workforce by either looking for a job or already employed. And we notice that this is starting to come down, and many experts said the velocity of money was going to go way up, and it would make sense that as the economy reopened, it should, but it's not. And what is that telling you? is the inflation we're seeing is not driven by monetary policy. It's not coming from the financial system. It's coming from supply chain issues. So as all of this money from all the fiscal stimulus gets worked through the economy, all of a sudden you're going to see demand start to go down. And perhaps we'll start to see that in the coming months of data, because we know that wages aren't keeping up with prices and there isn't inflation to keep them up. So if wages aren't rising, we need inflation. We need financial inflation. We need monetary inflation. We need something so workers can afford those higher prices. If they can't, well, then employers aren't going to need as many people working for them. And that's why you see this relationship between these two charts, and why it's likely that the labor force participation rate will go down as demand for labor falls with it. Another chart that many people often ask when we look at the velocity of money is, how is it possible I could remain bullish on bonds when interest rates apparently are going to go to sky high? Well, what you have to understand is what we're seeing is not monetary inflation. And again, the velocity of money tells you that. We're seeing supply chain inflation, which people are interpreting as monetary inflation, and they're reacting accordingly by selling bonds. But when you look at this relationship, much like the labor force participation rate against the velocity of money, we'll now look at yields against the velocity of money, and you start to see some things that make sense. And you'll notice that as money slows down its movement through the economy, rates fall. And why is that? Because what does lending do in our economy? It creates new money. So if the existing money isn't moving fast enough through the economy, rates need to fall to spur money growth. So now let's go back and look at this chart again, and you'll notice that rates are being driven up at ridiculous rates while money velocity is going nowhere, suggesting that rates will actually need to come back down to match in line with the fact that there's no monetary inflation here. Because what you see is when there is high interest rates during a period where there's slow money velocity, what does that tell you in terms of what's wrong with the economy? That we're not seeing monetary inflation. We're seeing, in this case now, supply chain inflation. And what does it mean? It means high interest rates are leading to tight financial conditions. Normally they tell you their financial conditions are easing, but in this case they're telling you they're tightening. And how do we know that? Well, go back to the Wednesday show and the Wednesday before that, maybe even the Wednesday before that, or next Wednesday when we talk about lending demand and we look at the banking system and you see refinance rates collapse. If we were seeing monetary inflation, what would we expect to see? Refinance applications rising as people pulled money out, refinanced their house, and higher rates didn't bother them. But when you see rates rising and you see demand for loans collapsing, and you start looking back at this chart here, it tells you the higher interest rates are leading to tight financial conditions and ultimately will need to come back down, perhaps quite rapidly. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.